Hey folks, Frank Zorrilla here, Zor Capital, Saturday the 5th of January, 10 o'clock in the morning. I want to do a quick video in regards to the market, just to let you know what it is that I'm thinking. And see where we can, come up with some ideas or some type of plan. So here's a SPY. We had a decent rally from December 26th till now, roughly almost 8%. Not bad at all. It's hard to say that this was imminent. But the point is that the market was really oversold, back on the week of the 24th. Almost every single index back then was below their weekly Bollinger Band, which is something that usually doesn't happen. It's rare, okay? And the SPY was trading below it, so was the IWM, so was the Qs, and pretty much every single sector out there. So, again, I hate to say that the bounce was imminent, but it was a very high probability trade, okay? Look, when the market is down, whatever, multiple days in a row, there's a lot of guys out there with scare tactics, and, it's going to be 1929, 1987, whatever the case may be. Crashes are rare events, okay? They can happen, but the probabilities are extremely low. It's so low that it's not even worth playing for a crash. Because usually you get some type of bounce. The market, for the most part, goes up and down, not up or down. Even back in 2008, when the market was down 50%, we still had rallies along the way. It just didn't happen in a straight line, and that's the reason why I'm a firm believer that when you're this oversold, you shouldn't even think about the short side or selling. Wait for that dead cat bounce, okay, and then offload. Then go and sell your holdings, go out there and short, or go out there and say we're going lower. But to do it here, it's extremely tough. And what typically happens is that the bear side always sounds better, okay? It's extremely believable, it sounds smarter, and people panic and they start to sell, and you get these huge volumes, okay? People get scared and they start selling at all costs. And the fact of the matter is, talking about volume, volume on the down days is always going to be greater than the up days. That's just a fact. I mean, when we have a correction, the volume on the down days is always going to be greater. People start to panic, and when they're scared and the market is down a lot, and then we start going higher, usually the volume is not going to be greater on average in the down days. And that, to me, okay, to me that really doesn't matter. And the reason why is that from this low to right over here is roughly 8%. The value of that 8% remains the same, whether or not the volume was high or the volume was lower. 8% from here and from here to here has the same value, with low volume or high volume. It's whatever it is. It's whatever it is. $20 on the SPYs. It's the same thing. You go to the bank and you deposit that money you made from these $20. They're going to give you 20 bucks. They're not going to say, hey, that the volume was low in the SPY, so that 20 is worth only 17. No, it's worth the same. Now, if you remember, which I know is hard, because a week ago, December 24th, seems like such a long time ago, we were extremely oversold. How oversold? Here, this is December 25th, 2018. We had, I think two stocks that were trading, above, two S&P 500 stocks that were trading above their 3-day, 5-day, and 10-day moving average, okay? Roughly 1%. As you can see here, this is a year-to-date chart. When you get this low, you typically get some type of bounce. That bounce, it's usually not the low. You normally get a retest, but you get a bounce. And the bounce are good enough for you to offload some of your holdings, okay, that maybe are down too much, or maybe you want to regroup, whatever the case may be. Those bounces give you the opportunity, if you think we're going lower, to sell some stocks. I'm a firm believer that you're much better off selling on the way up than selling on the way down in corrective markets. So we were extremely oversold, and we had a decent bounce. Here, we only had, this is a monthly chart of stocks above their 200-day moving average. At the time, we had 8% of all stocks were above the 200-day moving average. That's extremely oversold. This chart goes back to 1985 or 1986. Again, look, betting on this on these type of events, it's just not that, it's just a very low probability event. You have, many months here, whatever, 30 years, whatever the case may be, 35 years. And typically once we get down to these levels, 15%, the market typically bounces. So to bet on two events that happened, one in 87 and one in 2008, and think something like this is going to happen again in a straight line, it's a low probability event. One not worth even thinking about, or even whatever. It's just a low probable event. We'll leave it at that. Stocks above their 40-day moving average, again, got down to 3.55. This is extremely, extremely low. Again, 09, 1987, these are rare events. What else do we have here? And then the next day, right, on the 26th, we had a big day. We had an epic day. We had 1,779 stocks up 4% or more that day, and that's a big number. You only get those type of numbers usually after the market has corrected, or it's really oversold. This chart goes back to 2014. We had 808 over here. As you can see, the market was oversold. We had 939. This is the summer of 2015, which market took a little nosedive. We had 989, then we had 981. These things usually happen again during oversold markets when we're in a correction. You get that oversold bounce, you get a big move higher. Usually this first impulse low, it's not the last low. You normally get another low. And then you're off to the races again. This was back in 2000, late 2015, 2016, same exact thing. The market took a nosedive. Then when we bounced, we had 916 stocks on 1/29/2016, up 4% or more that day. This probably was 208, February 8th, 2016, where we had a little lower low and then we bounced. So the point is that you get these big numbers after oversold, after we're extremely oversold. Now going back to the 4% spikes. So here we showed 2014, and here are those dates annotated in the S&P 500 chart. 8/26/2015. Look, just like now, this looked horrible. It was, the world was coming to an end. We're going to crash. 1987, we had a huge bounce, we had a huge rally, and then we go back down again, and then we have another big 4% day. So when you look at this, okay, even here also, world's coming to an end, bounce, retest. What you want to remember is very simply, you don't want to get too low in the down days, you don't want to get too high in the up days, because the market is still very volatile, and we're going to we're going to swing. We're more than likely going to swing up and down, until volatility starts to shrink a little bit. Going back to 2011 is the last time we had such a huge spike. 11/30/2001, we had 1,951 stocks up 4% or more that day. 2011, if you remember, that summer was a tough summer. We were down 20%, I believe, and 18-19% during the summer. And we went into a nice little trading range where we had some down days, some up days. We had some big up days, some big down days. You can see here, this is 2011. Again, same thing, waterfall type of situation here. Very hard to buy, very hard to believe that that things are gonna get better. Or the bearish arguments start to make a lot more sense when we're down here. And God forbid you sell everything, then everything is really gonna make a lot more sense on the bear side. That's just the way it is. And then we had these huge bounces here. We had a big day for stocks up 4% or more. We had a decent bounce. Then we came back down, another decent bounce. So, again, these big up days as far as stocks up 4% or more, they're great, but, typically you're going to get them in oversold markets, and sometimes, that's not the first low. When you get the big one, that's just an oversold rally, and chances are that we might retest, we might not, but, you need to be aware not to get too high when we have these nice little retracements, after a big down move, not to get too high up here thinking that the worst is over. You know, take it easy and just don't go all in. Now you might want to try this, you know, when we're oversold again. If, you know, for example, the SPY here, you know, when we were down here, it was extremely hard to say, hey, I want to buy this because it looks like we're going straight down, which we were, and it looks like, you know, something bad might happen. But if you took the opposite of SPY, which is SH, right, which is, this was on the same date as this is December 24th. Now, would you buy this? Probably not. Now, this looks extremely overbought, okay? And it looks like, or it looked at the time where it was probably going to rest. And the upside was probably limited. And this was December 24th. So that, you know, so next time when we're in a corrective market and you see the SPY going straight down, take a look at SH and ask yourself, would you be buying this here on this day? And this was SH right over here. Yeah, big up move right over here. The world's coming to an end. And then, you know, now it's just had a, you know, simple retracement, okay? Back to the 20-day moving average. And the fact of the matter is, more than likely, you know, here after this move down in this type of market, chances are that, you know, right over here probably favors the bears. I would be probably more into going long here, the SH, than shorting the SH. Okay, now let's talk about the stuff that's working, the stocks that are working, that have worked the best here in the short term, okay? What I'm going to do here is I'm going to punch up the SPY, because what's working is the worst performing stocks, the stocks that were down the most. Those are the stocks that did the best over the last 8 days, which is not what you typically read, you know, in blogs or in books, that you need to buy the stocks trading near the highs, and those are the ones that are going to do the best after a correction. Could be, okay? But in the short term, that first initial move higher, okay? No. That first initial move higher, what's going to work best is pretty much the stocks that were trading near 52-week lows. So what I'm going to do here is I'm going to just show you. Let's just do this. Shift T. Let's look at the best performing stocks from this low to here. Okay, short. We're going to rank this by the best performing stocks from the December 24th close or low, and we're going to look at the high cap 1000, which is roughly the Russell 1000 stocks. And then here, Celgene, the best performing stock. This was a buyout, so it doesn't count. Netflix, again, trading near lows, up 27% since this little low over here. HES, again, look at this waterfall situation, bounces. This is a very nice, you know, this is a big move. CLR, same exact thing. You know, this is one of my favorite scans during corrective markets, is stocks that are down multiple days in a row, 3 days or more, and then up today. One of my favorite scans, because normally what you get is that you get this pattern of red, red, red. You finally get that green day. That's a change of trend, at least in the short term. And you know, you get long here, this green candle with a stop right over here, and then you can raise your stop every day to the previous day low. And if you take a look at this pattern, this is exactly what has worked best over the last 8 days or 5 days, whatever it is. Roku, same exact thing. NC, same exact thing. These stocks are all trading near lows. So in other words, when we have an oversold corrective market, if you want to look at the, you know, you want to get a scan to try to find the best performing stocks over the next 10 days, take a look at all the stocks trading near lows, or the worst performing stocks. All right, Melly, same exact thing, near the low. ECA, near the low. And this only matters, you know, if you're a short-term trader. Okay, if you're a short-term trader where your holding period is 1 to 20 days, and you're looking for a scan idea for this type of market, then this is it. Okay, this is what you do, and that's the reason why, in my firm opinion, the best book in regards to trading is this over here. Exactly what we're doing is that we're looking at the best performance stocks within our time frame. If my time frame is roughly, call it, you know, 1 to 20 days, and I want to create some type of scan, that's going to spit out, stocks that could potentially be the best winners for the next 21 days. What I'm going to do is look at, how, look for commonalities of the best performing stocks in the previous 21 days. That's just the bottom line. So you do that, and you might find that maybe stocks trading near lows is a little bit better than stocks trading near highs. If your time frame is 21 days, you might find out that, stocks priced, below 20 perform a little bit better within your time frame, which is 20 days, than stocks that are trading at much higher levels. So the point is, you run this scan on a consistent basis. You look at the stocks, the best performing stocks within your time frame on a consistent basis. You're going to find certain things that you can create your own scans, and you'll go out there and you'll bust a whole bunch of myths that are out there in regards to trading. 5, same thing, down multiple days in a row, up today, off to the races. Stock that was beaten up, BHC, same exact thing. Now, going forward, as this market matures, and we continue to go higher, chances are that these stocks are not going to perform as great as they did in the previous 5 days. Then we might be able to see stocks trading near highs do a little bit better. But that after that first low, that first impulse low, oversold stocks tend to work best. Okay, ET, same exact thing. We can go through this whole list, and you'll notice that the best performing stocks in the last 10 days are all trading near lows. Caesar, VNO, and these are big returns, people. I mean, this is a 19% return, nothing to sneeze at, okay? And just because it's trading near a low, it doesn't mean that it's worth less than a stock trading near high. 19% is the same if it's coming from a stock trading near a low, and it's the same if it's trading for a stock trading near highs, okay? The problem is that, we typically trade what we believe about the market. That's what we typically do. And if we believe that the market, that you can only make money by buying stocks near 52-week highs, then that's what you believe. If you believe that you can only make money by buying stocks, near lows, that's what you believe. If you believe in value, that's what you believe. That's what we trade. We don't trade the market, we trade our beliefs, okay? By studying the best performing stocks within your time frame, you can shape that belief to what actually is working now. So, CXO, look at this. These are all 52-week low dump diving. That's all it is. First Solar, MGM, same. And if you look at this list, right, to me right now, MGM, looks like a decent short candidate. I wouldn't mind shorting this stock going through 25.36 with a stop at 26.05. So even right over here with the Russell 1000, you take the best performing stocks over the short term, over the last 5-6 days, and this right here could be, a great short list. I think this is a decent risk reward trade here. Short at 25.30, if and only if it gets to 25.30 on Monday, with a stop at 26.05. Look at this, same exact thing. Down big, little nice dead cat bounce. Probably a good short right over here. CMG, look, down big, little dead cat bounce. 50-day, 60-day, 50-day, and 63-day moving average right over here. You can probably fade this in the first down day with a close stop. So there you go. So here, this is probably a great short list if you're into shorting as well. All right, let me answer some questions from Twitter. Let's see what we have here. Will the IWM outperform given less China exposure than the large caps? I have no idea. Should a novice investor be 100% short volatility right now or only 75%? I don't know. I don't know. Thoughts on gold? Not a gold fan. It can break out. If it does, it's going to break without me. I'm just not a big gold fan. How to become more disciplined and tips to improve my trading strategy, please. Okay, so how do you become more disciplined? You got to have a plan before the market opens. So typically, when I in the morning, what I do very simply is that I already have my list pre-market, what I'm looking to buy, my buy stop, my stop loss, how much I'm risking, how many shares I will buy if my buy stop is triggered. So you become disciplined by first doing that. And if you want to improve your trading strategy, is you very simply you just use an Excel sheet to write down to track all your trades, your longs, your shorts. Make sure that you write the reason why you bought them. Was it a certain setup inside day? Was it because had an NR7 through the high? It was down 3 days in a row up today. So you make sure you do that. And more importantly, you figure out what your average holding period is. And then you start to study the best performing stocks within your average holding period. So if it's 10 days, then study the best performing stocks over the last 10 days and start to write down some of the commonalities that all those stocks have. Are they trading near highs? Are they trading near lows? What's the flow? Price per share. Are they making money or losing money? Do the averages matter? You do all that stuff. Do you like pineapple pizza? Yeah. Is there a stock market cap range or price range that is not influenced by the index? Yeah, small caps, micro caps typically are not influenced by the indices, but the fact of the matter is when the market goes down and we're in a corrective market, everything goes down. So the small caps, micro caps, they're going to give you the bigger moves percentage wise, but if you have a big account, you probably can't trade them. If you need liquidity because you have a big account, then you need to go to larger cap names or higher flow, higher price. Hey Frank, we'd love to hear your overall take on some of the large Chinese tech names. Are there any different in the large U.S. techs? All right, so some Chinese stocks were holding up well, relatively well, versus the indices over the last couple of weeks. But then once that pressure was relieved from the market, they really didn't bounce until yesterday. IQ, UYA, At Home, NetEase, those stocks held up well. That little last sell-off that we had in the S&P 500, but we just recently bounced and they really haven't taken off. So much for relative strength so far. Bought Valero, low 70s. A good price to sell? Well, we won't know that after the fact. More importantly, if you bought in the low 70s, what's more important is you got to protect that profit and you put a stop loss. Where to sell, depending on your time frame. I'm a short-term trader for the most part when it comes to individual common stocks. I like to sell on the way up. So here's Valero. Valero, this is a stock that's been under severe pressure. You can see that 20-day and 10-day moving averages have been capping every single rally since October. We finally got above those averages just recently, and now they can be acting as support. This is what I call a possible character change. So if I was long the stock and if I was a short-term trader, my stop would be right over here at 72.95, 72.80, breaks this low, and more importantly, it'll break the 10-day and 20-day moving average. And then you can use these averages because of this little pattern here. You can use these averages as your stop. It just so happens that commodity stocks, oil stocks, gold stocks, they tend to be good trend stocks. If you can see here how Valero rode the 10 and 20-day moving average for a long time, you can see that here as well. So I will probably use these averages as my stop. Let's see what else we have here. All right, so that's about it. All right, so trade them well and be well. And to summarize, the market goes up and down, not up or down. If you believe we're going lower, use the rallies to take some off the table. If you believe we're going lower, crashes are a very low probability bet. They're just very low probability. They can happen. I know people scare you, whatever the case may be, but that's a very low probability bet. Volume on the way down is always larger than the up days. That's just the way it is. But just always remember that the gains, okay, remain the same. Whether it's up high volume or low volume, 10% equals exactly the same thing with volume or no volume. It's just the bottom line. So be well and have a great week.